Hey there students, this is Jeff Sokol from Deloitte, and the purpose of this video lecture is to give you a little bit of material to review and I suppose watch ahead of the class that I'm going to be guest lecturing at on October 18th. So I know that Rodney's put together a series of speakers for your different classes, and I'm one of them. And I also teach a master's class at San Jose State up here in the Bay Area. And one of the technologies that I use as part of that course is this video technology that you're watching now. And this year is the first year that I have done it, and I think it's pretty cool. It's a really good way for me to share information with the class outside of class hours, and for people that have an interest in wanting to understand the material even better than they could have picked up in class. It's a way of having a resource tool or a resource essentially to go back and see content again and again. So I put together this intro deck for you guys, but I also have posted a lot of materials like this on YouTube related to my master's class up at San Jose State. I mean, we're partway through the semester now, and I have, I don't know, 10, 12 hours worth of video up there, that sort of thing. So I wouldn't expect you to watch that, but I just thought I'd give you some of that technology background. In any event, like I said, I'm going to be guest speaking on October 18th, and if you could spend call it 20 minutes or so to watch this video ahead of that, and you'll see at the end there's a couple assignments for you to be thoughtful about ahead of class, then that will make class better on October 18th. Okay? And then I'll introduce myself more fully when I'm there live in person. I'll have a separate deck for you guys then, and that deck will have some background on me as well. So the topic for class when I teach on the 18th is going to be accounting for income taxes. And so you can see at the top of the slide here, financial reporting for income taxes. And so that's us not doing taxes, but it's us doing the accounting for taxes, right? And I spend a lot of my time up here working with clients around their accounting for income taxes, and it's what I'll try to impart on you in class when I'm there live is just the significance of this and what a big part of business it is for the big four accounting firms. So we're going to be talking about the accounting for income taxes. So think tax, but also think debit, credit, typical accounting. Okay. The ASC 740 guidance are the FASB rules that address how companies under U.S. GAAP ought to be accounting for income taxes. And it used to be referred to as FAS 109, but call it a half dozen years ago or so, the different pieces of FASB guidance were codified into different sections, and the income tax section is ASC 740. And you'll hear most people refer to tax accounting as, quote, doing the tax provision. When people say tax provision, they mean tax expense, meaning the amount of expense that a company will put on its income statement related to income taxes. However, when you read ASC 740, and by the way, it's a very difficult document to read. It's just not written in a textbook type style where you can read from beginning to end. It's really more just a series of concepts and methodologies to apply. But when you read it, it focuses on not the expense or the P&L side of the equation for accounting, but on the balance sheet. So when you go through the document, it will tell you that you do two things. And the first thing that you focus on is you compute your payable or receivable. Okay? So this right here, this is step number one. You're going to compute, well, how much income tax do I owe currently? And if I do it right, then I'm going to start my journal entry by saying, well, I'm going to credit my tax payable balance, right? So if I started a journal entry down here at the bottom of the page, I would credit my tax payable. The second thing that ASC 740 tells you to do is to recognize deferred taxes. So these aren't taxes you're paying currently, but they're taxes that you might have to pay in the future. Or it could work the opposite way. It could be taxes that you might save in the future because of tax attributes. We'll cover this in a lot more detail in class, but that second step is also a balance sheet entry. And so let's say that there's some fact that's going to cause you not to owe tax this year, but that because of things you know now, it's going to cause you to pay tax in the future. Well, rather than calling that a tax payable, that would be a deferred tax liability. Okay, so we're going to owe some amount in the future, right? Let's call that XX. And the third step, once you complete those first two, will really be just a balancing entry, right? Because if there's anything you learned in your accounting class, hopefully it's that the balance sheet has to balance. And so the balancing entry will be to tax expense. Okay. And so the journal entry that you'll put together will look something like that. But the key is that as you think about the end goal here, which for a lot of people is to quantify the income statement expense related to taxes, the end goal is really achieved by first figuring out what goes on the balance sheet. Okay? So we'll go through that in some of the examples, particularly when we have class there live. We'll go through some hypotheticals. But know that this is a balance sheet first, income statement second, even though when everyone talks about tax accounting, they usually talk about the P&L. Okay? All right. So this slide deals with total tax expense. So when you're looking at a company's financial statements and you see a line item there that says tax expense, I often ask students to tell me, well, what is that? You know, how is that different than the taxes that they pay or that the taxes that they show on their tax return? You know, what is that income tax expense number? And as you can see from this slide, it's really made up of three different things. It's made up of the current tax expense, right, which is this guy here. And the current tax expense is the amount that you currently owe. Right? You're going to file your tax return, you have to cut a check to the government. That amount, if you wanted to think of that as a journal entry, that amount would be, well, I'll debit my expense and I will credit my liability. Okay? Plus, it'll be the tax that you have to pay in the future, right? So if for some reason you have income today, but let's say you don't have to pay tax on it into the future, that tax expense will be included in your provision, as will any non-current expense. Okay? And non-current, if I can just put that in English terms, what that typically represents is taxes that relate to gray areas in tax law. Okay? So let's say that you don't think you need to file a tax return in the state of Oregon, and so you don't file one. But years go by, and then all of a sudden, Oregon comes knocking on your door and says, well, I think you should pay some tax. Well, they might be right. And what a lot of companies do is, and this is not really optional, a lot of companies will accrue that tax, right? They will accrue this knowing that there's exposure and a risk of a future payment. So really, if you think of these tax boxes, this is kind of the tax you owe now. This is the tax that you will owe or save in the future. These are things that are known. And this is non-current, these are generally exposures. Okay? But the idea here is that if you have $1 of income, there's some amount of tax you're going to pay on that. And whether you pay it now or in the future, you expense that tax today. I mean, that's accrual accounting, right? You accrue the expense when the facts create the obligation, notwithstanding that a cash check might be cut, you know, one day versus another. So really, we're trying to match the tax expense with the income that gives rise to that tax obligation. So it's not a function of when the tax is being paid. It's when is the income being earned that will ultimately give rise to the tax obligation. Okay? All right, so I know we've already spent 5 minutes and we're into, you know, kind of the terminology lingo here of provisions. So let me back up a quick second and tell you, well, if you've never heard of a provision, you know, where do I find it on the financial statements? So I in the first class I teach at San Jose State, I usually use Nordstrom's as an example. It's a pretty straightforward company from an income tax accounting perspective. And so this page is an excerpt of the Nordstrom's balance sheet from their last public filing. And then the next page you'll see is the corresponding income statement. And so I thought I would just show you on the income statement and balance sheet where you can find income tax accounts, right? Because if you heard the slide a few minutes ago, I talked about there being balance sheet entries for payables, balance sheet entries for deferred taxes, and then in a P&L balance related to the income tax expense. And so let me show you where those are, because sometimes these are tricky to find. So on the balance sheet, you would expect to see a tax payable, since that's what I showed earlier in the discussion. But these guys actually don't have an income tax payable account that they have called out separately. And the reason for that is that they must have an immaterial balance. And so what they probably have done is they've probably included in that other current liability section, I'll bet that includes taxes payable. So somewhere within that balance, that $764 million to the right, that probably includes taxes payable. The second balance sheet account I mentioned in the prior slide related to deferred taxes. And remember, this is tax that you might owe or save in the future, but that you know now. Okay? And deferred taxes are really, gosh, there could be anywhere on the balance sheet. And with these guys, they have a line here, right here, called current deferred tax assets. And so that's one line where you can see a tax balance, but that's actually the only place on their financial statements. There are no other lines here that relate to deferred taxes. And I suspect that that's not because they just have current deferred taxes. I'll bet that buried within this other asset or this other liability or these other non-current liabilities, I'll bet the deferred taxes are buried in some combination of those rows. I'd be surprised if they weren't. Okay, that's kind of how it works. So fishing out what's in the balance sheet can be a little tricky. But generally that's where it's at. Okay, so the income statement, again, this is a copy of the Nordstrom income statement from their last public filing. And here, if you were trying to find, well, where is a provision? If I don't even know what a provision is and I'm trying to find it, where would I look? Well, on the income statement, this one is pretty easy. So they have a line called income tax expense there. And that $436 million that these guys show, that's their expense. That's their tax provision. And I know I've said this several times already, but that 436, that isn't necessarily what they pay in income taxes, but that's the amount that they accrue under U.S. GAAP accrual accounting. Okay? But if you learn anything from this video lecture in terms of what is a provision and where do I find it, well, a provision is the income tax that you expense on your financial statements, and you can see that expense towards the bottom of the income statement. Okay? So the next few slides are some basic terminology related to income tax accounting. And I thought I would go over these pretty quickly. I don't expect that you'd retain too much of this from just watching this lecture, and this set of slides doesn't have examples like the ones we'll go through in class on the 18th. And I think when you go through the examples, you're able to put the stuff into context a lot more. But for now, I'll just walk you through the terminology, and we'll see if we can make sense of some of it. So the current expense. Okay, the current expense is basically the journal entry that you would book related to taxes that you owe currently. So I think what I was telling you earlier was that let's say I have $100 of income and the tax rate is 35%. Well, I would credit my payable for $35, and I would debit my current expense by $35. And that 35 represents, oops, a little messy, that represents the amount of tax that I would owe currently, and that's my balance journal entry. Okay? So let's say that I want to figure out my deferred expense, which is the next section here. Okay, so this gets exponentially more tricky. But deferred expense, so let me give you an example of how you come up with deferred expense. Let's say that a company has a bad debt reserve. Okay, so within that $100 of income that I mentioned earlier, they have bad debt reserve of 10. Okay? So the company's estimated what they think their uncollectible receivables will be, and they've decided to accrue a $10 expense. Well, for tax purposes, that $10 expense is not currently deductible. It's only deductible once you've basically written off the receivable, which usually occurs once you've concluded that there's no hope of collecting the receivable. Okay? So books estimates the expense today, tax gets to deduct it in the future. Okay? So if I was trying to account for that fact, well, the first thing I would do in my example is I would say, okay, the current expense is actually going to go up, right? Because if I have to add back that book expense for the bad debt reserve, meaning I can't deduct it yet. So even though books deducted it, I can't. So my tax is going to go up by 3.5, so $10 times 35%. So remember, within that $100 of book income, it included a deduction or an expense that's not currently deductible. So for tax purposes, I'm really going to be paying tax on $110 of income currently. So I need to increase my payable by 3.5, and that's going to increase my current expense by 3.5. So now I'm going to owe with my tax return the sum of 35 and 3.5, or 38.5. Okay. But on the flip side, I know that when that bad debt reserve gets written off and those receivables are canceled, I'm going to get a tax deduction. So I know that's going to happen. So I'm going to book a deferred tax asset today. And that asset represents the savings that I will get in tax in the future, because I know when this receivable is canceled, I'm going to get a corporate tax deduction. And when I book that asset, I'm able to then book a deferred provision. And this is pretty darn confusing, I think, if you don't have experience with the topic. But essentially what you're able to do is you book a benefit to your tax expense for the increase in your deferred taxes, right? So let me kind of describe it a slightly different way and say, this is my bad guy. I'm going to have to pay more tax today, so I'm going to accrue an expense. But I know that this is just a timing item. So this right here, that's my good guy. It's going to flip around next year or sometime in the future, and I will get a deduction for that book expense. So over time, if there's $10 of book expense, I ultimately save 3.5 of tax. However, I may not save that tax immediately, and so I'm going to book a deferred tax asset in the interim. Okay? So if you netted down all these entries, you can see that this provision entry and that provision entry actually offset. So timing differences don't actually change the amount of tax that you permanently pay. They might change which year you pay it in, but they won't change the fact that you pay or save tax. And because we're doing accrual accounting and we don't necessarily care when things get paid versus when they ultimately generate an expense, we don't book an expense for that kind of thing. We do move the balance sheet around, right? Our deferred taxes, our payables, all those things are moving, but there's nothing driving the expense. All right, I fully expect that to be confusing. You know, if you're intellectually interested in this stuff, watch it again. You know, you can watch the whole deck if you want. And we'll talk about this more in class, but that's kind of your first taste at what a current and deferred provision is. Your total tax provision. So we talked about this with that other slide that had the boxes on it, your total tax provision is the sum of the tax that you pay currently plus the amount that you pay or save in the future because of these timing differences, like that bad debt reserve example. So when you think about tax expense and you try to analogize it to what it is, think if you made $1 of income today, what is the tax that I will ever pay related to that $1 of book income? The sum of that tax is your tax expense. Okay? And you can see at the bottom of this slide, we talk about how, this is tricky because sometimes you don't know how much tax you're going to pay because there's these things called uncertain tax positions. So your tax expense, when you originally book it, often will include estimates of what you think will happen, but it won't necessarily be exactly what happens at the end of the day. So when we book a provision, there's definitely some rough edges to it. Deferred tax assets and liabilities. Okay, so when I was explaining the balance sheet first methodology of ASC 740, I mentioned that you first calculate what the tax liability is currently, and the second thing is you compute your deferred taxes. And so these are things that you know today, but don't impact your liability on this year's return, but will impact your liability on future returns. Okay? So this, in a way, there's a lot of common sense that can be applied to this, right? A deferred tax asset is the tax effect of future deductible amounts. So like in that example I just shared, in the future, when you write off a receivable, and you know you're going to do that based upon this bad debt reserve you've booked, you will get a tax deduction. Because you know that, you can book an asset now, you can anticipate the fact that you're going to save tax and put an asset on the balance sheet. Okay? Deferred tax liabilities are the opposite. Okay? So let's say, for example, that you received $100 of income, but for some reason it wasn't taxable this year. Like let's say it was you were using the installment method or something like that. Well, just because you defer it in the first year doesn't mean it's indefinitely deferred. You might have to pick it up as taxable income next year. Well, if you know that, and we'll talk a little bit more when I'm there in class about how you would know it, well then you would book a liability on the balance sheet. You would say, I know I'm going to owe tax. I don't owe it currently, so I'm not going to book it as a current tax payable, but I'll book it as a deferred tax liability. And that way, in the year that for book purposes I've shown that $100 of income, I've also told you that there's a tax expense. I have matching between my tax expense and my book income. And I do that by setting up a deferred liability. Last kind of substantive slides, and that is terminology related to UTBs and ETRs, a couple acronyms. UTBs stands for unrecognized tax benefit, and I know that term is not very helpful, so you can see from the bullet there that UTBs are tax reserves. These are your exposures. These are your contingencies, right? So think of that example about my state of Oregon. That is me recording a liability today because I expect that in the future I'm going to owe some tax even if I'm not going to voluntarily pay it. Okay, and that's what UTBs are. And you'll see, I'm going to ask you to do some reading about public companies in a minute. When you read those public company financials, look for the term UTB and know that that's their tax reserves. That's what they think their exposures are. Okay? That will give you an insight into what some of these companies are up to. And last thing that I want to talk through is effective tax rate. So up here in Silicon Valley, when you're talking to tax VPs or tax directors or CFOs, they all talk about their ETR. Okay? And your ETR is your tax provision, your expense. It's your expense divided by your profit before tax. Okay? And so you want your provision, obviously, to be as low as possible, right? Because if you're doing, the best tax planning you can, your provision will be low, and you want that, management group of yours to make as much money as possible, and so you want PBT to be high. So if you do that, if you get those arrows moving in the correct direction, then your effective tax rate will go down, right? It's just math. But one of the things I want you to think about is what makes a company have a high effective tax rate versus what makes them have a low effective tax rate. And trust me that when management, finance execs are thinking about the tax department, they think in terms of the ETR. That is the number one benchmark that they will consider. Okay, so that's your 20 minutes or so of lecture on the basics of income tax accounting. So now I have 2 requests of you, and this shouldn't take you a ton of time, but it'll make class, I think, a lot more interesting so that we can apply concepts to real-world facts. So I'm going to list off 2 of my clients, and I want you to read a little bit about them, and we can talk about them live. So Intuit is one of my clients. Intuit is the maker of TurboTax, and they're a very profitable tech company up here, software company that, like I said, makes TurboTax, QuickBooks, whatnot. They have a July year-end and would have just filed their Form 10K for their year ended July of 2012. So I want you to go get that 10K and read about their income tax accounting. Okay, and I put 3 questions here. So what's their effective tax rate? How does their effective tax rate differ from their statutory rate? Their statutory rate is basically the rate by law if you're a U.S. company. And if you had 5 minutes with the CFO, what would you ask him about the tax footnote? Okay, and so that last question gives you a hint that there's an income tax footnote in the back of the financial statements, just like there's a lot of footnotes about fixed assets or stock compensation or legal reserves. There's all kinds of footnotes back there. One of them will be an income tax footnote. So I want you to read through it and try to understand as much about it as you can, and see if you could understand enough to have a rational conversation with the CFO about what's interesting to you about the tax footnote. Okay, Intuit's a big company. I mean, it's a multi-billion-dollar a year company, but their income tax footnote is pretty straightforward, honestly. The second company that I want you to take a look at is Intuitive Surgical. I kind of picked these 2 companies because they have similar names. I thought that was funny. Intuitive Surgical is another client of mine, and they are in a different space. They make the Da Vinci surgical robot, which, if you're not familiar with it, is pretty cool. And so pull up their 10K. Intuitive Surgical is a calendar year company, so their latest 10K will be for calendar 2011. And take a look at their effective tax rate and compare it to Intuit's and see why it's different. Why is it lower? And just try to figure out the differences between the 2 companies. Why are they different? What is it? So anyways, take a look at that, and we can talk about it. Okay, so that's enough for the lecture, and anyways, I hope this was informative, and I'll see you in class on the 18th. Okay, great. Talk to you later.